So I appreciate you all being here on a Saturday morning. This is our home buyer seminar. To introduce our speakers, I got myself with the Elizabeth Monnick Group and EXP Realty, and I'll let Justin and Ryan introduce themselves.
Yep, Brian with Rocket Local, here in the J-Town office down the street.
And I'm Justin Hack. I'm a financial advisor over at Northwestern Mutual.
And then quick agenda for what we're going to run through today. So first part's going to be about the home buying process from myself. Just going to go about how the different steps of that, how it works. Oh, hey, come on. We got two spare at the back if you want to take those two, and then we got these two up here. Coffee and donuts at the back. So home buying process, then go over to the market conditions, let you know how things are right now, and then some mistakes to avoid. Then Ryan's going to talk about the mortgage process, and then we've got Justin talking about the financial preparation side of it. And then this is open as well. If anyone has any questions, feel free to just raise a hand and we'll get them answered. Some of them we may delay to the end when we have the question and answers part, but feel free to, if you want something restated or want to clarify something, please let us know. Okay. The home buying process. So this is a quick overview of the home buying process and how it works and all the different stages from it. First part's a consultation. Then you move on to the pre-approval process, which would be with Ryan. And then you've got the search aspect of it, the making an offer once you've found a house that you like, inspections, which we'll go over, and then the final closing process from going under contract. That is an overview, a very quick run through of the home buying process in each of those different stages. I'll go into a bit more detail about each of those. So the consultation, that is your first meeting with a real estate agent to go over what you're looking for, what your goals are, and what your plans are. Obviously, you can't just go straight out looking at houses without a plan because you need to know where you want to get to and what your main criteria is. So when it comes to looking for a home, you want to go into the details of how many bedrooms you're looking for, how many bathrooms you're looking for, square footage size. You also want to go on location, if you want to be a certain distance from work. All of that information helps your real estate agent find you the house that you've been looking for. You also want to go over your time frame as well. So a lot of people that we help are in rentals, and maybe you've got a lease coming up, and you need to know when the sort of time frame is to do that. Typical time frame on buying a house, from once you get your pre-approval, you're looking at around 8 to 10 houses is the average of how many you've seen before you make an offer, and that could take you anywhere from 1 day all the way through to like 2 months. Then once you find a house, you go into contract, and that's typically around 30 to 45 days. So usually when I'm talking to people about buying a house who's coming up with a time frame, the sort of latest moment when buying a house is going to be about, and this is where it's like under the gun, where you want to be a little bit before this, but if you're starting at 3 months before your rental, it's probably going to be a tough find because that process is going to go around quick. So the earlier that you can start is the better. We talked about the needs as well. Pre-approval, that's where you connect with a lender. For making an offer on a house, you have to have a pre-approval. You have to have some form of proof of funds. If it was cash, if it was a loan, you have to have that before you can make an offer. There's also some other benefits of the pre-approval. Goes over getting your budget. You want to know how much you can afford, what you can spend. Ryan's great at his job, and he'll pre-approve everyone for their max they possibly can, but that might not be where you want to be. Ryan will go through a breakdown of how much your payments are, and that's where you talk with someone like Justin to figure out what's a good level on those payments. So pre-approval is super important because you want to start looking at the houses in the price range that you're looking for. And then understanding payments. There's a lot of different aspects to a mortgage payment. It's not just paying towards the house. Ryan will go over that in more detail about the different aspects of what a monthly payment would be. Then the search. This is the fun part of the process. This is where you go out looking at different homes. You can see homes on Zillow, Realtor.com. We have our own websites. We have direct feeds to the MLS, which is Louisville's local search platform. That's where you go out, look at houses in person, get a feel for them, and just understand what you're looking for. If it's your first time looking, it may take you a few homes before you really get a feel of what sort of style you like. I always say about the gut feeling that after about 4 to 10 houses, when you walk into a house, you get that gut feeling of where you could feel like this could be the house for me. This is where I feel like I could live. You also get it on the flip side where you walk into a house straight away and see the linoleum floors and think, that one's not for me, let's get out of here. So the looking at the houses is the fun part. And people always say, what do I need to do when I'm looking at a house? And it is literally just walking in, seeing if you can picture yourself in a house, if you can see your furniture there, if you can see yourself living there. Typically what I do is I'll walk through and look for certain things that may be other factors you need to think of. I might see a little aspect that's kind of weird that would be like, hey, really consider this. It might have, a gas stove rather than electric, and making sure that you're looking at those aspects. I'll also try and keep an eye out for red flags to give you some insight to that ahead of time. Might see like a foundation crack, that's something to think of. It's not something that a home buyer typically looks for, but it's something that I'll be looking for. I'm not a home inspector, but I've seen enough that I could give you some insight into like, hey, this could be, you know, a big fix down the line. Then eventually you'll hopefully find a house that you like and you'll want to make an offer on, and that's a process in itself. It's a form that has been legally drafted, and it's a sort of a fill in the blank with all of your terms that we're going to offer to the seller. Those terms are going to be things like the purchase price, whether you're going to do inspections or not, how much down payment, what your earnest money deposit is going to be, and then any different terms, closing time frame. Typically, when we make an offer, we make it so it's beneficial for a home buyer. Now, and sometimes if it's a competitive house, may call the seller's agent and say, hey, you know, what is the seller looking for, in which we may need to tailor an offer to make yours stronger so the seller will like it. But that's something that your real estate agent that I would help you with and go through and making that offer as strong as possible to give you the best chance of getting that house. There's going to be a few things that can happen from that offer. The hopeful goal is that they accept your first offer straight away. That would be the best case scenario. The next one is they may counter back if the seller, you know, likes some of the terms but doesn't like some of the other terms. They may counter, trying to change some things, and that's where we could address that, see if it works for you or not, and hopefully get to an acceptance. Or the final thing is a rejection, that if they just, you know, might have another offer they've already accepted, or it just doesn't meet any of their terms, they may send a rejection to you. Then once you go under contract, you're going to be getting inspections. This is probably the most important thing about going through the process. Home inspection, this is an important number to write down. It's about $600 to $700. That is out of pocket. It's a one-time fee that you pay that at the time for a home inspection. And what a home inspection is going to do is they're going to go into a house and check the complete overall level of the house and give you a report on it. Home inspectors are not experts in any one thing, but they know something about everything. So they'll go through, they'll check the foundation, they'll check the electric, they'll check the plumbing, they'll check the roof and give you a full report and let us know what are issues and what aren't issues. They'll also let us know if we need to bring in a specialist. So one that we typically see is sort of like electrical issues, where they'll say this is an issue, it's not to code or it's not functioning correctly, to which case we could bring in an inspector, an electrical inspector, to have a full evaluation of that in a more detailed level. I say the inspection is most important is because you don't want to buy a house which has a bunch of issues that you're not aware of until you move in. So this is your way to sort of vet the house and make sure it's in a good way before you purchase it. Now, we do have a chance to submit a repair request. So what that looks like is once we get that report from the home inspector, we'll go through it together and outline all the big issues that we think these are roadblocks before making us go forward with the home. We can ask the seller to make any repairs. So we could say, we want you as a seller to fix A, B, C, and D from this report before we move forward. Now that is all up for negotiation. So the seller may come back and it's like, well, I'll fix A, B, and C, but D you've got to take on your own. And that's where we'd talk, we'd go over that report and say, what would this mean if they're not fixing it? How much is that going to be to repair it? It may come to the fact where it's like, seller's not willing to do anything, there's too much going on. We need to find a different house, which is a possibility. Typically though, most sellers are looking to sell their house. They're willing to do certain things to continue the process moving forward. Once you do go through the inspections, you'll go through the closing process where you get the home appraised. Around what are those running at the moment? About 500, and that's out of pocket. So that's another factor, another item that you should write down as a cost that you're going to have through the process. Now that appraisal, they're going to go in and check the value of the house to make sure what you're paying for it and what they're loaning you matches up. And if there's any discrepancies there, then that needs to be addressed with the sellers. You go through the underwriting where Ryan's going to be asking for a whole bunch of documents, and you're probably going to get annoyed with him, but it's important and just send them to him as soon as possible. And he'll go over that in more detail as well. But that's just going through your file and making sure that all the documents are there. And then before closing, typically 2 to 3 days before closing, you'll schedule a final walkthrough where we'll go to the house and check out a few things. One, if there was any repairs that have been asked on, we're going to make sure that those have been taken care of, and we'll have receipts and reports and invoices to make sure they have. The other thing, making sure it's in the same condition. Typically when you look at the house, there's most likely going to be furniture there, but at the final walkthrough, hopefully it's all gone, and it may uncover some stuff that we were not aware of before, or there could be some new damage. Movers get heavy-handed and they're moving something out and put a big scrape on the wall, and it's something that we could address then. It's very important because it's sort of your last step that you can really take a look at the house and address anything. Because once you close, it's pretty hard to then go back and get anything taken care of. And then schedule closing, and you'll go in, you'll sign a whole bunch of papers, and your wrist will get sore, but then you'll be a homeowner. Any questions so far? Nope. Cool. Okay, so talking about some current market conditions. At the moment, this is a changing market. It is very vibrant at the moment. Things are changing day by day, especially with everything going on in the world right now. So some quick stats for you. Last year, there was 2,500 homes on the market in the Louisville MLS. This year, we're now sitting at just over 3,100, and that's probably climbed a little bit over the last few days. Average days on market, this is all from these last few months. We haven't got March yet, but as you can see, they've increased from 43 days on the market to 64. And just to give you a little bit of insight, back in like 2020 to 2022, average days was probably like 7. So it's really increased over the last few years. And then average price, $345,000 in December, and then through February, $341,000. It's probably about the same for March. And that's supposed to be higher. That's $25,000 than higher than February last year. Now I give you these numbers and you're probably like, what does this mean for us? So at the moment, I don't typically say it's a buyer's or a seller's market. This is an opportunity market because there's opportunities for everyone. What this means for you as a buyer, the higher days on market, the more inventory and the more that the average price changes gives you as a buyer more negotiation room. Sellers aren't putting the house on the market and it's selling within 7 days or within 2 days or the first day. There are some homes it happens, but not every home. There's a lot of homes right now that are sitting on the market for a long amount of time. The longer they sit, the more negotiation power you have. The more homes on the market, the more negotiation power you have. So it's a great time to be out there looking because those factors are in your favor. So you can negotiate more terms, closing costs, which Ryan will give you some more information on. That gives you some money at closing. You can ask for more repairs. You can negotiate the price. They typically say, as a general rule of thumb, if you see a home out there on the market for every like 30 days, that's $5,000 lower that you can offer. So when you get into, there's some homes out there for 100 days on the market, that's a big reduction that you can make on that offering price. So some mistakes to avoid. Skipping the home inspection. I would never let any of my clients skip the home inspection. It's too important. I actually have a document that if you did want to skip it, I would make you sign that saying that I've advised you to get it and you don't want to get it. It's so important. Although it is a big amount of money, $600 or $700 out of pocket, it's important, but you need to know that report ahead of time. The last thing I want you to do is spend all this money buying a house because it is not cheap, to then get in and have to do $20,000, $30,000 worth of repairs that you were not prepared for. So a home inspection would never let you skip that. And the typical home inspection is home, pest, and radon. Home is checking the full condition of the home. Pest is for like termites and carpenter bees. And then radon is a harmful gas that comes from the ground that causes cancer. So you don't want that. Then neglecting hidden costs. We've already addressed a few of them with the home inspection and the appraisal. And there's some of them that Ryan will go over, which are some of your loan closing fees. There's a lot of costs that you have to factor into it and making sure that you're budgeting that correctly, which Justin will go over how you can prepare for that. And then rushing the process. That's back to if you're on a time frame. If you've got a lease that's coming up and you know, say it's expiring next year, now's a great time to start preparing, that you can start speaking to a financial advisor, start speaking to a lender and getting those things correct and in place. So when you're about 6 months out, you can start running and not have to feel like you're forced into a house. There's been some people that have come to me in the past and they're like, I've got a lease that's expiring in 3 months, I need a house now. We got it done, but they sort of had to settle for a house because of their time frame. And I don't want anyone to have to settle unless they really have to. So as much time as you can take, really take your time with it, find the right house that fits for you. It's going to be a lot less stressful as well. And then overstretching your budget. I always have a thing, don't want you to be house poor. So I want you to get a house that's within your means. That's something Justin's going to give you some more insight into, but do not overstretch your budget. It's real easy to be looking at a home at this price and see on Zillow, well, that one's just 20,000 more, I'm sure I can afford it. Or you might be able to, but is it in your best interest? Possibly not. Not getting pre-approved. Again, you can't submit an offer without a pre-approval. I don't show anyone houses without a pre-approval. That's just your number one most important step. As well, giving you your budget is really helpful because we want to be as specific and focused with our time as possible. So if you're pre-approved for here and we're looking at houses here, that's wasting time. Or on the reverse side of that, if we're looking at homes lower than where you could be, we're also wasting that time. We want you to be looking at the right houses. So getting pre-approved, super important. And then not preparing financially, again, that's starting as soon as possible and speaking with someone who is knowledgeable and skillful about going through numbers and explaining what works for your situation. Any questions about those? Okay, and then I think that's my section. So I went over that pretty quick. Any specific process questions that anyone has for me at this moment? If something comes later, we've got the Q&A section of that. Awesome. Well, I'm going to pass it on to Ryan now to go over the pre-approval process and how a loan works.
All right, guys. So I'm Ryan with Rocket Mortgage Local. Got a local J-Town office right across from the firehouse. Now, if anybody won the lottery yesterday or they have a few $100,000 laying around, I'm not the section you're interested in, but 95% of Americans finance their home purchase. Okay. So I'm kind of going to go over that process and what it looks like from start to finish. So what we look for when someone submits an application for a home loan, it's typically the big three, okay? So we have income, and your credit, and any assets, which is money saved up for a down payment, and closing costs. So the income part of it, we look at a 2-year history of stability. It could be different jobs, but as long as there are minimal gaps in between the jobs, typically we can look at that and get that approved. It's typically not about how much you make, but just the steady, constant income, because we just like to see stability. So the documents that we'll need for income, typically if you are just regular employed, not self-employed, we'll get a couple pay stubs from you, a couple W-2s. If you are self-employed, we'd like to see 2 years of tax returns, just because that will lay out how much you're writing off, what your gross or net loss is for the year, and that'll be able to let us determine how much you can afford. So that kind of carries on to our next section with the credit, okay? So we look at credit scores and also credit history. Now I can pull a credit report that isn't anything that you have to provide me other than a social security number and a date of birth. Most loan programs will take a credit score over about 620 to 640. Now we can go as low as about 580. However, a larger down payment would be needed, and there's some kind of there's a few different types of compensating factors to make up for the riskier credit score for financing approval. And then we also look at any assets. So my question will always be up front is, hey, how much do you have set aside for a home purchase? Most loans require a down payment of around 3% to 3.5%. Now, if you're a repeat home buyer, that moves up to about 5%. To get a little help with that, we do have a few grants and down payment assistance programs that are coming this summer. We do have existing grants if you meet eligibility, which is typically income limit. We do a 2% grant that will help you towards your down payment, and then you'll just be on the hook for the 1%, which is the minimum typically in most loan programs. Also with credit, we also have a credit repair department. It is free to use. It's super easy for me to refer you over, and that is if you fall under that 580 credit score range. Even if you're in the 600s and you want a credit score that's a little higher, you'll get a better interest rate. And so that's a free service that we offer to help out, and that'll ultimately save you on a monthly payment every month with a lower interest rate. So I'll also get with you on your goals. Okay, so this kind of piggybacks on the importance of starting early, which Alex already mentioned. Especially with me, a lender, I want to make sure that we have all of your ducks in a row as early as possible to get you that better interest rate, to make sure we're approving you for the max that you can go for. But also I want to set up a goal in terms of what does your next year look like at work? Are you expecting a raise? What is your monthly payment budget going to be? And so that's also important. And then location as well. Now, when I run an approval, I also run what your property taxes are going to be for the house. So that can affect things. Like if you tell me, hey, I'm looking in Louisville, well, I can say, okay, well, the effective property tax in Louisville is 1.2% of the home value. I'll calculate that in your monthly payment. And that monthly payment will also determine how much you can get approved for. Now, if then you turn and say, well, actually, I plan on moving to Ohio. Well, Ohio has a tax rate that's double here in Kentucky. So that's going to affect your approval. Not that I'm saying anybody's going to, wake up in the morning and be like, man, I really want to move to Ohio, because I sure don't. So anyways, so the importance of starting early, that is the most crucial part of all of this. Because if you need to improve your credit score, if you're self-employed and we need another 6 months of self-employment just to get those tax returns, that is absolutely crucial, because I can't get you approved until all of these things are met. Now, and I don't want you to go on your way with Alex and have him show you 20 houses when you can't make an offer on it. It'll get your hopes up. So that's why the boring part with me, we have to take care of. Okay. Also, like I said, we want to make sure we're approving you for the max, even though you might not go for that amount. If you're expecting a raise, if you have bonuses. So we typically like to see a stability in income, like I said before. If you make any type of commission or bonuses with your employment, we have to see that 2 years of history, and then we'll average it. That way, if you make X amount this year and then you make a little lower next year, we have to average that, because we can't get you approved based on what you made last year and then you're not making that much this year, if that makes sense. It's just a whole risk thing. So the easiest way to do that is to go ahead and submit an application with me early. It's super easy. I have a website. You just plug your info in there. It takes about 10 minutes. Now, if you see my cards in there, let's see here. Don't know if this has my application. So there's a little QR code on the back. So you just scan that with your phone. It'll take you to my website. Once you do fill out an application, I'll get a notification, and I can reach out to you, and we'll make sure it's all structured and everything set up perfectly, so I can go ahead and issue your pre-approval when the time is right. Your pre-approval letter is your golden ticket to make an offer with your real estate agent. You guys, I know it's a lot of information I just spit at you. Do you all have any questions about that? And yes, Alex.
How long does a pre-approval last?
So a pre-approval lasts as long as your credit report is good for, which is about 3 to 4 months. Our credit reports that we pull are 4 months. I like to stick around that 3-month mark. As long as your income does not change, or any money that you have set aside for a home purchase, you don't go buy a car with it or something. So as long as that stays the same, we can always refresh your credit report, pull a new one at the end of that 3 mark, so you can go and have a refreshed pre-approval letter to look at houses and make an offer. Okay, Justin.
If interest rates change, how easy is it to redo your pre-approval and see if you can get a better interest rate?
Yeah, absolutely. So I go ahead and look at everyone's pre-approvals once a week if you're out looking at houses. If the interest rates drop, your monthly payment will drop, making your approval purchase price point higher. And I'll get with you when that happens, and it's super easy to adjust that a little bit for you. Yeah.
Running a pre-approval, does that affect your credit?
Yeah, so it's a part of the process. When we initially pull a credit report, we do a soft pull. Most mortgage companies and banks will do a hard inquiry. We do a soft pull up front, and then it will still give us the 3 scores, so that will not affect your credit score at all. If it's high enough, I'll go ahead and like when I say it's high enough, when it's in the mid to high 700s, I will say, hey, let's go ahead and do a hard inquiry just so we can have a credit report that will stick for longer, and that will affect your score about 2 points. But that's just kind of the collateral damage that's needed in order to pull a credit report. A lot of people are like, well, why are you going to do a hard inquiry? I'm like, well, it's a risk thing. We have to do a credit report. I mean, if we're going to lend you hundreds of thousands of dollars, it's just, you're going to have to take a couple points hit on your credit report. So, yes.
A lot of questions.
You're fine. Yeah.
I'm interested. How much are closing costs?
Closing costs can run anywhere from about 2 to 3% of your purchase price. So the breakdown of the closing costs. So we have the lender fees, which is basically the processing and underwriter fees that are constant and stable. So those are the labor that takes to process all your documents, run all of the reports that are needed, flood reports, risk management reports, everything. Then you have your title company fees, which is the attorney's office that handles your deed and getting all of the I's dotted and T's crossed to make sure that you have a clean title when you move in, everything looks good, there's no liens on the property. And then the third aspect of that is your prepaids. So prepaids are basically your homeowner's insurance and taxes that are collected up front. Typically, the homeowner's insurance, you pay the full policy for a year at closing. Okay, so if you close in June, that policy will be good until next June. So that could run about $2,000 to $2,500. And then your taxes, we put on the loan estimate a full tax bill, and then depending on the full tax bill for the purchase price of the property that you buy it for, not last year's taxes. It'll be the estimated tax that you will pay the year that you buy the house. Because homes naturally appreciate, also your tax bill, unfortunately, no one likes taxes, that tax bill will always go up. So we'll collect the full tax bill, and then depending on what time of the year you buy, you will get credited by the seller for those months that the seller lived in the house, because you don't want to pay their portion of the taxes, and that will get allocated and adjusted. So that's where you get the 2 to 3% of the closing costs.
And that's typically sometimes in the market that we're in right now, we could write that into an offer to have the
Yep.
seller pay some of those closing costs.
Mm-hmm.
So for quick numbers, let's say you were making an offer for $100,000 and you wanted them to pay $5,000 closing costs, we'd typically up your offer by that $5,000 to make it $105,000, and they pay those closing costs, so it's less you have to pay out of pocket, and it only adjusts your monthly payment and then more.
Like $6.
Yeah, so
Yeah.
it's worth it. It's more keeping as much money in your pocket right now and putting that to use, so buy furniture or other things you want to do.
Yep. Anybody else have any questions? If you do, my number is on the card, so you guys can reach out to me, call, phone, text, anything you need. So, all right, I will let Justin take the floor. Yep.
There you go, sir. All right, so these guys got to talk about the fun stuff of, buying a home and, the exciting part of actually getting to move into it and go and look for houses. I'm here as a word of caution, in a fun way. So when you think about purchasing a home, this is one of the biggest expenses you're ever going to have in your life. And whenever you think about a home purchase, in the context of a financial plan, it needs to fit within a budget. I've seen this time and time again where people will go out, work with good people like Alex and Ryan, they get pre-approved for a good amount. And what the lender will do is pre-approve you for an amount that you can technically afford, but does it fit within the rest of your budget to allow you to be able to plan for other things? And so what I want to talk about today is budget scarcity, right? So there's so many things that we need to be able to help our clients to do to prepare themselves for the future. So these are just a few things that we help people with. So major life events, job change, family planning, having kids, home purchase, right? There's all these big life events that happen, and they need to be factored into a financial plan early. There's things like risk mitigation. So a lot of times people don't have the proper amount of things like life insurance, disability coverage, long-term care planning, right? All of these things have a cost to them. And so if we saddle ourselves with a very large monthly payment for a mortgage, it makes it really hard to accomplish some of these other items, right? So investment management, right? So if we've got a large monthly payment for a mortgage and then we feel like we're strapped and living paycheck to paycheck, it might be a little difficult to put away money for things like retirement or things like that future property or things like a kid's education one day. So there's only so many dollars in the budget, right? So a lot of other things here that you can see that we typically will help clients just understand and then put it within the context of a financial plan. But more specifically, if you're working with Alex and Ryan, what's that target number that I can afford for my budget, right? So you work with Ryan, he gets you a pre-approval letter, you start thinking about, okay, this is the monthly payment, but how does that monthly payment fit in with everything else? Right, so if you think about where money can go, there's really only three places. I like to call it the 3 F's. So you've got fixed expenses, you've got your future, and you've got your fun, right? So fixed expenses, that's gonna be the biggest chunk. So typically we like to see clients keep that at 60%, right? So if we keep our fixed expenses at 60% of our overall income, that means we can have an even 20% of our income to put towards our future, and we can have another 20% to put towards our fun, right? What happens all the time when I meet with clients is, let's say they've pushed this up to 75%, right? 75% of your income goes to all of your fixed expenses. Well, now we've got 2 other buckets to fill, the future and the fun, right? We only have 25% left. So we're gonna put 20% towards our future and eat ramen every day and only have 5% for the future? Or are we gonna do 20% towards our fun, which is more likely what's gonna happen, and then we don't put enough towards our future, right? So if you push this 60% over that number, it tends to be something where you have a choice that doesn't result in a really good outcome. So that's why, again, back to what Alex and Ryan were saying about preparation, a lot of home buying is about showing up to seminars like this, having conversations early, really trying to figure out how can I save an appropriate amount for a down payment so that I can see how much that down payment is going to affect the actual cash flow from a monthly payment perspective. Right, so you'll notice here, housing, under the 60%, and you notice that it says no more than 30%. So when you're working with somebody like Ryan, this is the really big target piece when you think about what that monthly payment is, right? So if, let's say, Ryan's able to get you a pre-approval, but that monthly payment would exceed 30% of your income, well, that's probably a flag to say, yes, you could technically afford it, but what's the trade-off there? What are we giving up to be able to buy that house that's 40% of our income?
The future and the fun of this.
Exactly. So you'll notice this here, just some general highlights around what really you would consider as a fixed expense. But as a follow-up to our seminar today, I'm going to send all of you guys a foundational financial planning packet. It has an actual budget in there where you can actually plug in some numbers, try to calculate this for yourself. I'm a big believer that a better awareness leads to better outcomes, right? So if you know where your money is going, then you can actually articulate, well, what can I go out and afford, right? Home buying is a very exciting process, and I think a lot of times what happens, and Alex, you might have a story or two for this, but people go out, they start looking at houses. I mean, this is actually personally me too, looking at houses with Alex. We went and looked at a few, and then all of a sudden we were like, well, this house is nice, but maybe if we just upped our budget just a little bit. And then we go start to look at other houses, and then you're like, well, I kind of fell in love with this one, but then you reverse engineer that back to the monthly payment, and you're like, hey, this is something that isn't really gonna fit. So it's an important conversation to have with, I would say, your kind of house buying financial team here. So open conversations with Ryan, with Alex, and somebody like myself as a financial advisor to really help guide you through what truly fits, right? I'll pause here. Any thoughts or questions on budget in general? Pretty straightforward, but okay. And then the last piece I'll just touch on briefly is just like, what does financial planning look like? So financial planning is it's an ongoing process, right? So it's not something where you come in necessarily for a quick consultation, we give you a couple of recommendations, and then we never see you again, right? Financial planning is an ongoing thing. So typically when I work with clients, I want to work with them for the next 30 years, right? So I want to be a member of the family, help them with all their major life decisions. And so it's an ongoing process of identifying goals. We create a personalized plan for you. We go through the implementation of that plan, and then on a recurring basis, we're going to review that, and then we might identify new goals, and then go back through the circle, right? So if you see in the inside here, wealth preservation and distribution. So that's things like estate planning at the end of the road. You've got wealth accumulation. So that's when you're in the, let's say the 25 through 50 age range, when you're in that accumulation phase of your employment. And then you've got risk management, which is extremely important, especially the younger you are, right? So these are all things that together build financial security. And purchasing a home is one of the most fun things. It's going to be the space that you get to call yours. It's a very endearing thing when you think about like where you live, right? It's one of those things that's really important to be taken within the context of a financial plan so it doesn't become a stressor. So, any thoughts or questions on any of this? So I know, I came in at the end where all the fun stuff was already talked about. Now I'm the guy talking about budgets, but it's really, really important stuff for sure. Alex.
So I know you're great at getting people prepared for buying a house. Once someone has bought a house and things change all the time, what sort of input advice do you got? I know you covered it a little bit there, but like towards that going forward, how does that sort of look and making sure that it stays in a good place?
Yeah, so I think making sure you have proper emergency funds in place, right? So that's a big, big thing. I always think of an emergency fund as the prerequisite for more complex planning. So if I meet with somebody and they're like, hey, I like to day trade in Robinhood and I just bought a house and I would love to talk about investing with you. And I'm like, okay, well, how much cash do you have? And if they only have $3,000 in their bank account, well, I'm probably gonna tell them like, hey, I'm not gonna work with you on any investments until you build the emergency fund. Because when you buy a home, I bought my first house for $99,500 11 years ago, and it was for sale by owner. It was a rental property for 20 years before that. Sweet old lady. It was on the market for $105,000. I talked her down. I was in college and I was like, please, this is the most I can afford. And I move in and I've had to redo everything. Like the furnace has gone out, the air conditioning's gone out. I've replaced all the floors. I've had to redo the kitchen. So all of these things cost money. And so if you get into a home purchase and you don't have, obviously you need to have your down payment, but you also need to make sure that you're not putting yourself in a position where you don't have anything else to fall back on. Because homeownership can be awesome, but it can also kind of suck a little bit when big things pop up that you have to fix. Great question. Anything else?
I'll add something too.
Yeah.
So also, I see this a lot in the mortgage world where I'll do someone's financing, get them set up, they close on the house, they call me the year after, and they're like, hey, my XYZ passed away. They left me this amount of money. Would it make sense for me to pay down my mortgage or refinance the house to have a lower monthly payment? I typically will advise them, like I am not a financial advisor, but I will advise them to talk to their financial planner and ask them, hey, is it smart to pay off some debt versus take that money and invest it? Mm-hmm. Typically, the latter is most, like, unless their monthly payment's crazy and they're kind of struggling paycheck to paycheck, typically taking that money and investing it is what I advise people to do. So what do you think about that?
Yeah, no, I think it's case by case, and that's why financial planning is so important. Is because your circumstances and fact pattern might be completely different than yours, right? So sometimes, like if you had a 3% interest rate on your house, we're not encouraging you to pay anything extra on that. That's free money. If you have a 7.5% interest rate, well, it might make sense to put a little bit towards the mortgage, maybe see if you can get a little lower interest rate and recast the mortgage so that you can have a lower payment, right? So it can make sense, but again, yeah, very much case by case.